You don't always have to make a prediction and then you're right or wrong based on whether or not it happened. You have to anticipate, and you can anticipate something, be wrong, and not have to pay the price, meaning always have a loser when you're wrong. What we're doing here is anticipating. So the point is markets always break out, and they generally break out of what? Of a consolidation, a range. It's choppy. Top of the range, why does it tend to break out? And when it goes is because there were enough shorts in here that are now climbing over everybody to get out. Shorts are buyers, they're future buyers. They have to buy it to cover their short position. And if there's enough of them, it's why price leaves a consolidation and breaks out to the upside. Now, you don't have to anticipate that it's going to break out to the upside. If you're wrong, you lose money. But again, you're just paying attention like a driver in the car. This guy might slam on his brakes in front of me. Well, why do you say that? Because the asshole in front of him just cut him off or is about to cut him off. I could see he's nosing out. And if the asshole in front of him does what I think he's going to do, this guy's going to slam on his brakes and I'm going to rear end him. But because I'm aware and alert, I'm taking my foot off the gas and slowing down. And then, boom, everything you thought happened, and you avoid rear ending someone. But if you were wrong, it's not the end of the world. It's not like someone's going to say, yeah, you dumbass, you slow down for no reason. What's the matter? Well, some people might have their wife tell you that, but you get my point. No one's going to blame you for slowing down a little bit, anticipating something that didn't happen. But when you're right, you put yourself in a position to save something. So everybody should always anticipate a breakout, where it could happen. Now, the when goes back to the tools you have, or the tools you don't have, and the tools you should get. What's going to create a better, like, when is it going to break out? I see where it could break out, but when? And what's going to clue you into that? Right in here are two numbers that relate to each other. It's the number of people who want to buy it versus the number of people who want to sell it. The word is want. Future buyers versus something. You can't just say there's a bunch of future buyers unless you know there's not a lot of future sellers. Because if I say there's a lot of people who want to buy this thing, and someone says, yeah, but there's a lot of people who want to sell it too. You get it? Then there isn't a lot of people that want to buy it enough to rally the price of that given product. But if you know there's a lot of people who want to buy it and there's not really a lot of people who want to sell it, that's getting you closer to the when moment that it might indeed break out. But first, you have to anticipate that it can break out and understand why. So these two numbers relate to each other, 606, 220. They're not just a total accumulation of how many people are bidding versus how many people are offering on your price ladder. Any platform could do that. Most of those numbers are I don't want to say fake, but they're not real. They're not necessarily real buyers who want to buy it and sellers who want to sell it, because once it gets there, they pull or whatever. But we're able to track orders that are tight to where price is, that are actually moving around, meaning they're actually aggressive when they move up their bids or down because they're offers. As soon as we tag orders that get close to getting filled and they're moving up, meaning they're aggressive, to us, that confirms or almost verifies that they're real, that they're going to play ball. They want to get filled. When they're aggressively moving, when you're moving price lower and you're a seller, you're aggressive, you're probably real. When you're moving price up and you're a buyer, you probably want it. You're aggressive. Up if you're a buyer, down if you're a seller. Now, once you start to tag different orders that are in the book to kind of verify that they're real and they're going to play ball, now you're getting into better order flow. Now you have to compare and contrast these orders. Once you filter out the ones that are bullshit versus the ones that are probably real, then you look and say, okay, let's compare them to each other and let's see how those change. And then use it with our ability to anticipate. So if I play it, take a look at this number, 606, 220. Watch this number and what happens. It actually gets wider, meaning there are more people who want to buy it and less people who want to sell it. It's 638, 209. Now it's what? 146, 120. This number And then as you get used to watching this number in this relationship, you'll know what's high and low. Like it doesn't get below 150 a lot. So when it does, don't be surprised anymore. When it doesn't get below 200. So when it does, and the ratio starts to widen out, don't be surprised anymore that it could break out. And remember what I said at the beginning of this video. You're already anticipating that the market could rally and break out. You're already anticipating the guy in front of you is going to slam on his brakes. So when he does, you'll never get credit for the people in the car saying, "Hey, good job. How'd you know he was going to stop? Wow, that really saved us." You'll never get that credit. You will get yelled at if you slow down for no reason. You'll get, I don't, but I know a lot of guys out there do. Anyhow, um, I'm married to a maniac. She drives faster than me, and I drive pretty fast. And I would say I'm pretty aggressive, above average. But she could handle a car, and she doesn't like following people that are too slow. Either way, you get my point. If you're anticipating and you actually called it, you saved yourself. How did you know? Well, because you're paying attention. So then it goes like, or how did you know it could break out? Well, I didn't know it was going to break out. I just seen that if it breaks out, this is why it would break out and where, based on breakouts. And then you get the ingredients. But this number, the market's already rallying a little bit. You don't want to get caught where you're telling people it's going to rain after they're wet. That's not a helpful prediction. You have to be able to see this stuff before it rains. And so before you even see clouds, let me back it up. You're already seeing this ratio become imbalanced before price went up. Now, it's a more valuable prediction. Got it? It's a more valuable prediction because it hasn't rallied yet. And you could see that now it's got the ingredients to rally. Then, based on just understanding where it could break out, based on market breakouts, you put yourself in a position to time your trades a lot better, or get the hell out of a short that you might be in. Even more important. Now you're not chasing. Now you're not one of those that are chasing, because in every rally there are a lot of shorts that are chasing it. And that's a lot of times the reason why it rallies, because there's a lot of shorts chasing it. Remember our red or green line? That's called the laser. And that's right here. That's right here. That's inside the chart here. All that says is there are more shorts than longs over the last 2 minutes in a sample size, not all longs and shorts, but a sample size. And so that's a ratio that's also bullish. Why is that bullish if there's more shorts than longs? Well, because shorts are future buyers and longs are future sellers. If you don't know that, well, now you do. And it gets to the point where, yeah, the gas pedal's on the right and the brake is on the left when looking down at it. It has to be that simple. If you're going to learn to drive, we got to start there. If you're going to learn to trade, let's start with longs are future sellers and shorts are future buyers. Why kind of start there? Well, because most people don't even understand why price moves and they're trying to predict it. So let's get there. Let's answer that question. Why price moves in the first place. So if there's more shorts, it's bullish because there's more buyers. If indeed you agree that shorts are future buyers, you have to agree to that. And if you don't agree to it and you're short right now, I bet you got a buy order below to get out and a buy stop above to get out for a loser, and probably an OCO connecting them, right? So you are a future buyer if you're short. And if you're long, you are a future seller. And I bet you if you're long right now, you're got a sell order above for a profit and sell stop below for your stop loss, right? For your loser. Either way, I think everybody agrees to this algebra. So if just by that, if you have more shorts, then you're going to have what? More future buyers. You got to put the word M in here. More future buyers, more shorts, more future buyers. And if you have more future buyers, isn't that kind of what the price of anything needs to go up?